Welcome to Countats. In this lesson, we're going to be looking at the General Ledger, specifically the Trade Receivables General Ledger account, or the Debtors Control General Ledger account, or Debtors General Ledger account. However, it may be termed, they mean the same thing really. Here, we're going to show you how to do the T account or the General Ledger account for trade receivables for a specific period in time, and I'm sure after this, you should be able to have a good idea of how to do this. Now, this is our first lesson on the General Ledger account for trade receivables specifically. We have also done another lesson which is a bit more advanced than this one, so if it's your first time looking at the T account, you might want to check this one out before you check out the one that you'll find in the link in the description below. That one is where we also incorporate VAT. How do you capture the T account for trade receivables if you have VAT? So after this lesson, you can check that one out. Additionally, we've done another lesson on explaining what trade receivables is. We go into great detail in explaining how it's accounted for, how it affects the financial statements, how we do the general journal for trade receivables. So if this is your first time looking at the T account, it's your first time looking at trade receivables, and if you're not even sure what trade receivables is, you might want to check out that lesson before checking this one out, because it will give you a very good foundation on the topic. So you'll find it in the link in the description as well. One more lesson that I will refer you to if it's your first time doing a T account or the general ledger account, or you're always confused with it, you might want to check out Accounting for Beginners, specifically part 3. But of course, it will be very helpful if you check out the whole series from part 1 going all the way to part 3, although we continue, but part 3 specifically looks at how we do T accounts, how we do the general ledger, and so we go into great detail on that one. So you can check that one out, and you'll find the links to all those lessons I've just mentioned in the description below. So in this particular example, we are told to record the above transactions in the Trade Receivables General Ledger account for the month ended 31 January 2025. So we know that this is specifically for a month, unlike the one that I alluded to, which is more complicated. That one is for a year, but it's not that complicated, as you will see if you go through it. Okay, so this one here is for a month. We are focusing on the month of January. And so that's the first thing you always want to do when you're looking at an accounting paper. You want to go to the required before you look at any other information, so that you know what you're doing even as you read through the information. So we're doing the T account or the Trade Receivables General Ledger account. When you hear me saying the word T account, I also mean the General Ledger account. Those are interchangeable terms for the same thing. Okay, now that we've read the required, we know it's the T account for January 2025. Let's look at the information. You are the accountant for Golden Threads Limited, a company that sells clothing on credit. The following transactions occurred during January 2025. And then here we go through the information. We're given the information from number 1 all the way to number 9. So we have to see what information affects trade receivables, on which side is it going to go, and what information does not affect trade receivables. Remember, you might be given information. It does not mean that the information does affect your trade receivables account. Okay, and we'll go through the information and see which one does. And here I've already put the Trade Receivables General Ledger account, or the T account. You can see it's in the form of a T. That's why it's called the T account, but it's a general ledger account nonetheless. And then we have our date, details, and amount here on both sides. We've got the debit on the left hand side and the credit on the right hand side. So if you've checked out our lesson, Accounting for Beginners part 3, this should be quite familiar. So let's go through the information and see what we do. Now, let me just give you a brief explanation of what trade receivables is. These are the people who owe us money, or our clients who bought from us on credit. They didn't pay us cash, and now they owe us the money. So we put them in our books as trade receivables or debtors. Okay, so it might be debtors or trade receivables or just receivables. So you just have to know these are people who owe us money and our dealings with them. Another thing to bear in mind is that trade receivables is an asset account, and our assets increase on the debit side. And that's why I said if you checked out Accounting for Beginners part 1 all the way to part 3, you should be very familiar with all this information. But this is for someone who has not checked it out, or just a reminder for you. Okay, trade receivables is an asset, increases on the debit side. This is very important information when you're doing your T account. So whatever increases our trade receivables, meaning whenever we sell goods to our customers or we charge them interest, whatever makes them owe us more, we put it on the debit side. Whatever decreases our trade receivables, we put it on the credit side. That is the case for all our assets. Okay, that's the rule. If you checked out Accounting for Beginners Part 1, you will note that we have an acronym called DEBT. Okay, debit, expenses, assets, and drawings, and then we credit liabilities, income, and capital. So trade receivables is an asset. Okay, and we apply that here. So whatever increases our trade receivables goes on the debit side. Whatever decreases our trade receivables goes on the credit side. What increases our trade receivables? Like I mentioned, whenever we sell to them on credit. Another one is if we're charging them interest, maybe for late payment. What decreases our trade receivables? The obvious one is whenever they pay us. That means it decreases how much we are owed by our trade receivables. And the other one is, of course, whenever they return goods to us that they bought from us on credit, then we would have to remove that amount for those specific goods. So those are the things that you need to have in your mind as you are doing the trade receivables general ledger account. So let's go through them one at a time. The trade receivables account had an opening balance of 35,000 Rand on the 1st of January 2025. Now remember, we are doing this for the month ended 31 January 2025 as the required had stated, and so we are given the opening balance. Whenever you're doing your T account, you always look at what your opening balance is. Of course, unless you're doing an expense account or an income account, you don't have opening balances because they would be closed off. Otherwise, if you're doing your assets, you're doing your liabilities, or you are doing capital or drawings, then you would need your opening balance. Okay, and they will usually give you that amount. Otherwise, they will state that there was no opening balance or the opening balance was zero. And so in this case, they are giving us the opening balance. Sometimes they will give you the information regarding opening balance, but it won't be the first line item. Okay, so this is a very simplified example for someone looking at trade receivables for the first time, or someone who's confused with doing the trade receivables general ledger account. But sometimes it will be hidden in any of the other information stating what the opening balance for trade receivables general ledger account is. Another way they could have stated this is by saying the trade receivables account had a closing balance of 35,000 Rand at 31st of December 2024. Now, we know that the closing balance for the previous month, i.e. 31st of December 2024, is the same as the opening balance for this month, 1st of January 2025. So don't be confused or thrown off by how they word the information, okay? So we have our opening balance for our assets. Our opening balance goes on the debit side because that's where it increases. Our assets increase on the debit side. So we're going to put our date, 1st of January 2025, and we put our amount as 35,000 Rand. And of course, what do we call our opening balance? Balance brought down. Whenever you have to put down your opening balance in your T account, you put it as balance brought down. So let's do just that. The 1st of January 2025, balance brought down 35,000 Rand. Easy enough to do that. That's what you always do for your opening balance when you're dealing with trade receivables. By the way, another lesson you'll find the link in the description below is for trade payables. We'll go through a similar example and you see how different it is from trade receivables. So you'll find it in the link in the description below as well. But this one here is how you account for the opening balance for trade receivables or any other asset that you may have. Okay? So we can go back here and highlight as we do it. You want to get into the habit of highlighting what you have done or ticking it off or scratching it off, whatever you need to do. That just shows us what we have taken into account of and what we still need to take into account. Okay, let's look at number 2. Customers returned goods worth 18,500 Rand during the month due to defects. What does that mean for our trade receivables? Remember, these are people who bought goods from us on credit, and now that they're returning goods to us, they don't owe us for those goods any longer, so we need to put it on the credit side. And here, they should have worded it better by saying credit customers returned goods. Because remember, your cash customers, or those who buy from you on cash, can return goods to you as well, which has nothing to do with trade receivables. But in this case, it's credit customers who are returning goods to us, and it's worth 18,500 Rand. So whenever they return goods to you, and these goods were defective, as we are told here, we'll put it on the credit side because that reduces how much our customers owe us. So we're going to put this 18,500 Rand on the credit side. Now here they didn't tell us to put dates. If they did tell us to put dates, they would have provided us the dates for these specific transactions, and you will use those dates that you have provided. But since they didn't give us the dates, we'll just use the month end. Okay, so here's how we're going to record it. We're going to record the amount as 18,500. Remember, this is on the credit side. And what is the description there? Sales returns. Remember, when our customers return goods to us, we call it sales returns. What account is sales returns? Well, sales returns is what we call the contra sales account. Okay, that's what reduces your sales. And if you know your income statement, you know that the first line item is sales, but we also deduct your sales returns. That's why it's called the contra sales account. So we put it on the credit side. They detail their sales returns. The amount is 18,500. And since they didn't tell us to put the dates here, we're just going to put the month end, 31 January 2025. So here's how it's going to look. 31 January 2025 sales returns, 18,500 rand. You will note here that the date that we're putting is month end, while the balance brought down that we had done earlier is the beginning of the month. Why is that? Well, your balance brought down at the beginning, or the opening balances, you always have to put the first of that specific date, okay, or the first of the month, or the first of the financial year if you're dealing with the financial year. But otherwise, if someone returns goods to you and you're dealing with trade receivables, as long as it's credit customers who are returning goods to us, we put it on the credit side. You call it sales returns, and you put the amount for the goods that were returned. Okay, so let's go back here and highlight number 2 as we've just completed that one. You can see it's quite a simple exercise for us to go through. Number 3, payments were received from customers totaling 123,000 rand. Again, these are customers who owed us money. They bought from us on credit, but they have paid us this amount, 123,000 rand. And so we're going to put it on the credit side. Why is that? Well, because that's reducing how much we are owed by our trade receivables or by our debtors. Okay, whenever they pay us money, we put it on the credit side, which reduces how much we are owed by our debtors. So we're going to put 123,000 rand on the credit side. The detail there is bank. Okay, so we're going to do just that. Again, our date is the end of the month, and since the previous one already captured the end of the month, we're just going to continue without having to repeat the date over and over again. So bank 123,000 rand. That's easy enough, right? Whenever your trade receivables or your credit customers or your debtors pay you money, always go to the credit side and put bank 123,000 rand in your T account. So let's go back and highlight that one there. Now what I'd like to ask you to do is to pause the video here, attempt to do the rest of the questions, draw your own T account, and then come back, continue the video, and mark yourself and see how much you get or how well you do. You'll be in a much better position than just following along, because you'll be able to know where you might be going wrong or what you might be misunderstanding, or that you're on the right track with doing the T account. So go ahead and do that. Okay, I hope you've attempted the entire paper, so let's go ahead and see how you have done. Number 4, the business purchased office equipment for 50,000 rand, paying in cash. Does this affect our trade receivables? And I should have said this. The first question you always ask yourself is, does this affect my trade receivables T account? Okay, and that's for any T account really. You want to ask yourself, is it affecting my T account? Well, first things first, this is the purchase of office equipment. It's not the purchase of trading stock or inventory. And so usually when we're dealing with the trade receivables T account, we're dealing with how much was bought from us on credit. That's the first thing. The second thing here is that it's the business which purchased, not customers who purchased from us. Okay, so that's the second thing that eliminated from being under trade receivables or affecting our trade receivables. Thirdly, even if the other two things I've just mentioned is not applicable, it says that we paid in cash. Okay, so the first thing is we are the one who purchased, so it has nothing with trade receivables or with people owing us. The second thing is this is for office equipment, but thirdly, we paid in cash. Okay, so even if it were customers buying from us and they were buying inventory from us or trading stock from us, but they paid in cash, whenever our customers buy goods from us on cash, it has nothing to do with trade receivables, because they don't owe us because they bought the goods on cash. I hope that makes sense. So we're just going to highlight this one here because it's not applicable for our trade receivables. So let's do that. Let's look at number 5. Bad debts amounting to 7,800 rand were written off because the amounts were deemed irrecoverable. So what does this mean? Whenever we write off specific debtors or trade receivables, whenever we are told that it was written off, that means that they are bad debts. That means that we have to remove them from our books because they no longer owe us this amount, in a sense. Okay, because we're writing them off. We're actually writing them off because we don't believe they'll be able to pay us back. Okay, so it's not like they don't owe us because we're just letting it go. No, that's not our intention. The reality is we don't believe we'll get this money any longer, so we might as well just remove it from our books. So bad debts goes on the credit side, and I hope you knew that already, because as I mentioned at the beginning, trade receivables is an asset account, increases on the debit side and decreases on the credit side. So whenever we are writing off our bad debts, we put it on the credit side, 7,800 rand, and we call it bad debts or credit losses. So you might be familiar with one of those two terms, either bad debts or credit losses. Okay, but here we're going to call it bad debts. But if you write credit losses, you won't be penalized because it refers to the same thing. Okay, so we're gonna put bad debts on the credit side, and the amount there is 7,800 rand. So let's do just that. Bad debts, 7,800 rand. So let's highlight that one as having been done. Number 6, credit sales for the month amounted to 165,000 rand. Now, What is this and how does it affect our books? I hope you already know this is quite easy. Whenever we make a sale to our customers on credit, that affects our trade receivables and that increases how much they owe us, and we put it on the debit side. So we're going to put it on the debit side and we're going to call it sales 165,000 rand. Because we now have more customers or more amounts being owed to us because we just sold on credit. If it said cash sales, then we know it has nothing to do with our trade receivables. Okay, trade receivables are people who are buying from us on credit, not cash. And so let's go ahead and do that. The detail is sales, which is an income account, and the amount there is 165,000 rand. So whenever we make a credit sale, we know that we have to put it on the debit side of the trade receivables T account. That's always easy to do. So let's go back, highlight it because we've just completed it. Number 7, the company issued a credit note to a cash customer for 12,000 rand. Now what is happening here? Well, a company is issuing a credit note. What do we understand a credit note to be? A credit note is something that the company would issue acknowledging that they now owe whoever we are issuing the credit note to. Why do we issue a credit note? We are issuing a credit note for one of a few reasons. Either the customer is returning goods to us, or we gave them defective goods, or they've already paid for goods and we do not have that specific good to give to a customer, or it could be a service that we didn't provide to a customer and now we are issuing a credit note for an invoice which was initially issued. And so when we issue a credit note to a customer, that means they no longer owe us for that specific amount, or we might be owing them because maybe they had paid us earlier and we need to refund them. In this case, we need to check, is this a cash customer or a credit customer? Well, this is easy. We are told here the company issued a credit note to a cash customer for 12,000 rand. That means by saying that it's a cash customer, it means they paid us this 12,000 rand, but now we are telling this customer they no longer owe us the 12,000 rand. And so when we issue them with a credit note, we're either going to refund them or we're going to deduct this 12,000 rand from a future service or good that you're going to provide them. So in this case, it's a cash customer. If it were a credit customer, then we know that we'd have to put it on the credit side, okay? Because it's like a return of goods from a customer, but in this case, we're just told it's a credit note being issued to a customer. But since it's a cash customer, this has nothing to do with our trade receivables. So I'm hoping you did attempt this question and you were able to pick that up. So this one is not applicable to our question, so we're going to highlight it. If you'd like to understand more on credit notes and debit notes, we've done a lesson specifically on that as well. You'll find it in the link in the description below, and many other lessons that you might want to find. You can go to our channel and you can search for any of the lessons and you should be able to find. So let's look at number 8. Customers who paid early were given a discount of 9,600 rand as per the company's settlement terms. So when we are told that customers who paid early, that signals that this is for credit customers, those who bought from us on credit and now they are paying early. What does it mean by early? Well, remember we have credit terms with our customers who buy from us on credit. We might give them a 30-day credit term, meaning that they have to pay us within 30 days. And so if they pay early, it means they're paying us before the 30 days lapses and we're issuing them with a discount. And so when we issue our customers with a discount, that means they no longer owe us that specific amount for discount. In this case, 9,600 rand. It means we're deducting 9,600 rand from whatever they owe us because they are paying early. Okay, we usually issue a discount to encourage customers to pay us early because the earlier we have cash flows, the better it is for us as a company. So whenever we've issued them with a discount, we know that we're going to put it on the credit side of the trade receivables account because it reduces how much they owe us. And I'm sure if you checked out our first lesson in explaining what trade receivables is, you understood this as we showed the journal entry that you have to pass when you issue discount to your customers. And so we're going to put this on the credit side and call it discount allowed. What account is discount allowed? That is an expense account. So here's how it's going to look. Discount allowed 9,600 rand. Quite easy to do. Whatever makes our customers owe us less, whatever reduces the amount that they owe us, we put it on the credit side, as we've been mentioning for all the other items that are on the credit side. Okay, so let's go back and highlight that one. Number 9, an invoice of 20,000 rand initially recorded as a debtor was found to be an error and should have been recorded as a cash sale. Okay, so here we have to now think very carefully how it may apply to our trade receivables or how it may affect our trade receivables. What is happening here? Well, there's an invoice of 20,000 rand, which was initially recorded as a debtor, meaning we recorded it as a trade receivable. So what journal entry did we pass in this case? Well, we debited trade receivable and we credited sales. Okay. and it was found to be in error and should have been recorded as a cash sale. So here, customers or a customer bought from us on cash, but we mistakenly recorded it as a credit sale. Okay, that means we raised a trade receivable as opposed to just recording bank here. So what journal entry did we pass? We need to ascertain what journal entry we mistakenly passed, and here is what we mistakenly passed. Okay, we debited trade receivables with 20,000 rand in this case, and we credited sales with 20,000 rand. There was an error that we made, but where did we make the error? Since it was a cash sale and not a credit sale, we should have debited bank and credited sales. Remember, you always going to credit sales whenever you make a sale, regardless of whether it's a cash sale or a credit sale. Okay, but in this case, since it's a cash sale, we were not supposed to have raised a trade receivable. We are supposed to have debited bank. Okay, so we know that our credit here, sales, is correct, but our debit is incorrect. Okay, so we need to reverse this debit by putting it on the credit side. Okay, so we're going to credit trade receivables, and what do we debit? We debit what we should have initially debited, which is bank. And so here's how it's going to look. We corrected by debiting bank as we should have initially by putting bank as a debit, and we are reversing the trade receivables of 20,000 rand by putting it on the credit side. Okay, so I'm just showing you how the journal would look like when you are correcting the error, so that makes much more sense when you see that we're actually going to go to our T account and put bank on the credit side. Remember, we're putting the opposite account when we are doing the T account, and I'm sure you already know this if you checked out our lesson on accounting for beginners part 3. We've also done another lesson called suspense account and correction of errors, where we looked at errors such as this and how we make corrections. You'll also find that lesson in the link in the description below. So let's do the correction. Here's how it's going to look. We're going to put the detail there as bank, and the amount is 20,000 rand, and we know why. Okay, we're putting it on the credit side because trade receivables is credited. Okay, and the correct amount which should have been debited was bank, as I've already mentioned. So let's go back and highlight that one. As you can see, we've highlighted all the line items that we're supposed to look at. Okay, and that is the value of highlighting, because you can easily see if you had missed something, we would have seen that we have not highlighted it as yet. Now that we have done everything, let's balance off or close off our account. So we'll go back here, and how do we close off or balance off the account? Well, if you checked out our accounting for beginners part 3, you already know this. What do? We look at the debit side, we total them up. We also total up the credit side and see which side is bigger. If the debit side is bigger, we're going to put the total of the debit side on both sides. If the credit side is bigger, we're going to put the total of the credit side on both sides. And so if we are to total them up, you will note that the debit side is bigger. Okay, you've got 165,000 rand and 35,000 rand. So if you add the two together, that is 200,000 rand, as opposed to this one here. Just by looking at it, you can see that it doesn't come close to 200,000 rand, but you just have to do the calculation yourself to make sure that that is the case. So we know the debit side is the bigger side, so we put it on both sides as totals. Okay, 200,000 rand on the debit side, 200,000 rand on the credit side as the totals. Now the next question we ask ourselves is, what is missing on the credit side to make it equal 200,000 rand? So we're just going to take the 200,000 rand minus the total of the credit side, and that will give us the amount, and we're going to call it balance carried down, and the amount there is 21,100 rand. Okay, so now we know that the debit side is bigger by 21,100 rand, so we need to go to the debit side. Under the total, we put the date of the following month, which would be the 1st of February 2025. Remember, this T account was for the 31st of January 2025. Now we are putting the date for the following month, which is going to be the opening balance for the following month, which is this 21,100 rand that the debit side is bigger by. Okay, so here's how it's going to look. We put the 1st of February 2025, and we put balance brought down, and we put 21,100 rand. Now, if we were to do the T account for February 2025, we're going to put the date here as the 1st of February 2025, balance brought down, and we put this 21,100 rand. Okay, so it's just a carryover from the closing balance of the previous month, as we did with this one here, this 35,000 at the beginning. And I'm sure you understand this if you checked out that lesson, as I've been mentioning. And this is how you do the Trade Receivables General Ledger account, or the T account for trade receivables or debtors. I hope you've gained value from this lesson. I hope you now know how to do the T account. If it's your first time, I hope it's now much easier to do the T account. You can now check out the second lesson that we did on the T account, which is more advanced than this one here, and you'll get a much better understanding of how questions are usually asked. If you have indeed gained value from this lesson, consider subscribing to our channel, like this video, and share it to those you think it might help. Till next time, cheers.